and visual communication tools are created equal. With Y charts, each output is a powerful visual that brings your analyses to life and intuitively explains the why behind your strategy. Go beyond a simple price chart and educate clients about the levers that truly impact performance or risk, and emphasize your most important insights with flexible chart annotations. Plus, custom branding, colors, and disclosures position you to fully own those insights. Go to ycharts.com to start your free trial. My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there is Ophir Gottlieb. Ophir, you sent me a DM with a thread that I shared at the top of the space, and I wanted to read the whole thing, which is why I played that uplifting music. But it really is actually a phenomenal thing you laid out. So I want to get into that. But before we do any of that, introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Sure. Thanks for having me, Michael. Always a pleasure and a privilege. My name is Ophir Gottlieb. I've been in professional finance for 25 years, a mathematician by training, financial mathematician by training, analyst of record for some tech companies through FactSet and Refinitiv, published for applications of artificial intelligence, in particular supervised learning and artificial and neural networks. It's on SSRN, former hedge fund manager, former option market maker on NYC Arca and SIBO, and currently the CEO of Capital Market Laboratories, a company we started 9 years ago, which I was entirely institutional in my background, and I've taken this company, started this company with the chairman, the great James Kaplan, kind of a grandfather of modern portfolio theory, and created research that is available to institutions, certainly, but mostly focused on retail. That's kind of the best I got for you.
Do you think being a mathematician is a positive or negative when it comes to trying to think about the future? And I say that purely from the perspective that a lot of modeling tends to not really exactly explain the way the world works, despite all the variables that might make it seem so.
Yeah, modeling in finance in particular can be fool's gold. So I would say it's helpful in, mathematicians are very, not to invoke Elon Musk, but we're very first principles, just we start at the very basics and move forward. And that can go anywhere in life, right? Like how does a piece of paper crumple? Right. How does snow melt? How does heat from a source move? So in that sense, I think it's great because it offers a really deep understanding of the way things work. But certainly any of the stems, and the longer you do it, you start to become, there's certainly a tendency to become overly analytic or analytical. And overly analytical is basically a curse as a trader. So it's, I think I've formed sort of two forms of my mind. One which is very analytical and mathematical and looks for an understanding, and the other which says, yeah, you can't do that all the time. And I'm really grateful for the time I spent as an option market maker because I had to leave a lot of that behind. So it's a fair question, and I think being too one-sided is actually quite deleterious. You can also, it's not, I don't feel I'm this way, but I think that if you're too analytical, you can become sort of tribal. And then if you're tribal in trading, you do whatever you want with your perfect life, you're just going to lose money. So you can't hold on to strongly held beliefs so much so that you're unable to see things are changing. So very long answer to can be good, can be bad.
Now, of course, I'd argue the bane of any scientist's existence or mathematician's existence is error, right? That variable, I always call error luck, right? It's either good or bad, right? Just in a mathematical format. And that relates to complex dynamics with markets, chaos theory, butterfly effects. I wonder if you think that we're in an environment where the error part, that variable, either positive error or negative error, is maybe a bigger and bigger portion of the way that the world works. Because it does seem like there's a lot more randomness, and a lot of things that people relied on in the past are not really working as one might think.
Yeah, so I'll maybe alter slightly my view. Error is not actually the bane of the existence for a mathematician. Unpredictable error is, right? So stochasticity is, I'm a stochastic mathematician, not that anyone cares, but so that's okay. It's when the error term, broadly speaking, becomes unpredictable. You start to get this, well, I don't want to get jargon, but you start to get an error term which is no longer predictable. If the error term is no longer predictable, then you haven't necessarily parameterized the problem as it should be. And it's the bane of existence if you're trying to predict something. It can be a signal, though, if it becomes obviously unpredictable, then you know it's time to move away from that. I do think we're in a time right now where which happens a lot in life, by the way. It's hyper focused right now in the market, and that's what we're here to talk about, which is great. But we are at a time now, or it does happen that we start to get contagion effects in anything, right? It can be a contagion effect, just personal relationships, right? You say something that just doesn't sit well with a group of friends, at dinner, and you lose a friend. And then when you lose that one friend, they kind of start texting each other, and then you lose another friend, right? So contagion effects don't have to be just credit or whatever, or I studied earthquakes. It doesn't matter. But I think we are at a time where contagion effects are taking hold. Unfortunately, these contagion effects are taking hold not just in, say, some of the more obvious places we look, let's say credit. They're also happening geopolitically. They're also happening, let's say, macroeconomically, let's say in the workforce. And so I would be hard pressed to say we are not in a place where we're seeing multiple contagions, which are certainly inflaming each other. So it's a scary time. And as a mathematician, it's sort of a fascinating time because these things we're trained to see, we have to use, like very unusual examples to take real world applied mathematics. And now, in a certain sense, like this is the perfect time for mathematicians. Like, what are you going to do? So, and I think that's, roughly speaking, that's basically what you talk about on your Twitter feed. You put it in different words. It's much more palatable. It's much more understandable, but that's what's happening. There's knock-on effects of almost everything. And as the knock-on effects happen, they're self-exciting. They create themselves again. And I think that's what we're facing. I think it's hard to argue that. And that makes predicting the future very difficult, and also means what we would normally, I think, Michael, what you and I would call like a tail event. Maybe that's not in the tail. If you're saying something's a tail event, that means you have some parameterization of the distribution, right? It doesn't matter. And you're saying like it's really far on the left side or really far on the right side. Well, if you cannot parameterize where we are, then how do you know it's a tail effect? How do you know it's in the tail? Maybe it's probable. And I think that's the scariest thing, is that tail events, either you can say tail events are more likely to happen, which in reality means they're not tail events.
Okay, so I think this actually is very close to home, because I think this is fascinating, even in the context of one of the posts in that thread, which I shared at the top before. And you mentioned it a little bit earlier, earthquakes, that earthquakes tend to cluster. Okay, first of all, go through that. Why'd you put that thread out? Because I think it's actually for those that are in this space, I encourage everybody to take a look at it and spend some time to really think about it. Explain the sort of link of the stochastic element to tails to clustering, and why this is such a really fascinating juncture just in terms of how things can play out.
Yeah. So in general, when we think about, and Michael, if I wax rhapsodic, just interrupt me and say, dude, can you get to the point? It's fine. You're not going to offend me.
It's a risk, man. I think you're one of the brilliant people in the space. I don't see where I say that. So please.
Okay. No problem. I still say, if I wax rhapsodic, you can interrupt me, but thank you. So generally when we think about there's something called stochasticity, but that's just what mathematicians call randomness. It's randomness. Okay. So if I slip into like mathematicians speak, they're synonyms. It's the same thing. So I don't mean to say that. Okay. So just don't get confused by a word you've never heard. It is a word you've heard. It's called randomness. All right, let's start there. So in general, when we face randomness in life, it is multidimensional. But oddly, when we think about it, and we're taught it in whatever grade we're taught it, we think about things like rolling a die, like rolling dice maybe, or flipping a coin. That's how we're taught randomness. And of course, that's random. But just because it's random doesn't mean it's not well behaved. If you take a perfectly normal coin, we know there's a 50% chance it's heads and 50% chance it's tails. It's random. That's what we were talking about at the beginning, Michael. But that's not the bane of existence for a mathematician. It's very well behaved, actually. Very well behaved. Or a dice, what 1 in 6 chance of any of those numbers, right? So that's very well behaved. That's fine. Those things we can deal with on it's expanded beyond flipping a coin, throwing dice. We now take it into the economy, right? There's a 1 in 6 chance X happens. It's very well behaved. We know why it would happen, what the odds are, what we would do if it happens. That's not so bad. Now the outcomes could be conceived as bad, right? Maybe I'm just making up a number. I'm not making a prediction. Maybe we're rolling a die and there's a 1 in 6 chance we'll have a recession. Just making up a number. We don't want a recession, but we know what a recession is. We know what to do when there is a recession. We understand the randomness involved with it. Got it. What really starts to infect and break down markets or life is this idea of a second stochastic process on top of the first one. Okay. So there's some incredible mathematics that comes out of Japan that we don't really talk about in the finance world, although we should because of Ito, but but they actually, Japan is an island which is like, it's seismically active, like disaster waiting to happen. So obviously it's very important for them to understand earthquakes. Okay, so let's say you and I walked out of our door one day and someone just told us there's a 1 in 10 chance, 1 in 100 chance of an earthquake. You live in California, maybe. We can deal with that. We have earthquake insurance, duck and roll, get under a table, avoid glass. We understand what to do when there's an earthquake. It's not a good thing. We understand how it happens and how frequent it should be. It turns out that has a name. It's called the Poisson process. Okay? It's like a jump process. It's what happens in the normal, let's say, stock market. That's how it relates to stock market. A stock moves 35% in a day. It's a jump. It's like, whoa. Okay. It turns out earthquakes aren't quite that simple. If I'm walking out today and hasn't been an earthquake in a year, there's a 1 in 100 chance there's an earthquake. I'm just making up a number. But if there is an earthquake today, on Friday, then on Saturday, the odds are not 1 in 100 of an earthquake. The odds move to, let's say, 1 in 10. Okay. Don't take the orders of magnitude as, just take these nominal values as contrived examples. Right? It's 10 times more likely there's an earthquake tomorrow if there's an earthquake today. And if there's an earthquake today and tomorrow, then there's a 10 times higher chance that there's an earthquake on Sunday. Okay, that is called doubly stochastic. You have this random jump, this 1 in 100 chance, but then you have this self-excitement. If it happens, well, now the odds of it happening go up. And if it happens for the second time, now the odds of it happen again. And those tend to be exponential, right? So it doesn't go from 1 in 100 chance to a 1 in 99 chance to 1 in 98 chance. It tends to go 1 in 10 chance, 1 in 100 chance to 1 in 10 chance to 1 in 2 chance. So why the hell does this matter? Well, it turns out this is kind of how credit works. And it's been well defined. Really great professor at Stanford that I had, but also used to work for Barra, which is now MSCI, and Lisa Goldberg, and another great analyst. They described credit like this. And that makes sense, right? Because that's exactly what happened in the dot-com bubble, right? There were a lot of dot-com companies. They needed infrastructure. So there's all these, they didn't call it the cloud then, but it was the cloud, like companies like Exodus. But then the dot-commers started going bankrupt. Right? Which means that the places offering infrastructure started having fewer and fewer customers. And they have these, back then it was airplane hangars full of basically computers, and they started to go bankrupt. Well, if they started to go bankrupt, that means Cisco could no longer provide their switches and routers. And that's exactly what happened. That's a contagion. It also happens in credit. The company that makes the rubber is going to go bankrupt, and that increases the odds of the company selling the shoes going to go bankrupt. Okay, so that's how it relates to finance. Now, how does it relate to today? This thing is called the Hawkes process, this self-exciting process that has like this random feature, and then this other part on top of it, this doubly stochastic part, this doubly random thing, this self-excitement. It's called a self-affection. So, okay, so why does that matter? This is a reality that goes far beyond earthquakes or far beyond credit. And this tends to happen in many ways in geopolitics. So, for example, I'll take us through the most recent cluster shock we had that people will really identify with, and then we'll move forward for a sort of a prediction. So COVID was actually a start of a cluster shock, right? So yes, we had the shock of a pandemic, which has, I don't know, happens once every 80 years. Like it's an earthquake, right? Okay. But after that, we had a monetary shock, a fiscal shock, an asset shock, a supply chain shock, a food shock, an inflation shock, right? And then it started creating geopolitical shocks, right? We had the invasion of Ukraine by Russia, right? And then the idea that China could invade Taiwan, right? And now we have the Middle East, right? That's another cluster shock, right? The odds of one happening increase as one happens. And then when a second one happens, the odds go up again exponentially. So here we are today with a geopolitical cluster shock happening, kind of inarguable, a credit shock, which is quite possibly going to happen. I think, Michael, you might have some strong opinions about this, right? We have possibly a shock happening in the employment market, right? So, okay, Ophir, what would that be? Well, what are the odds that a large union, goes on strike? I don't know, 1 in whatever. Okay, but what are the odds that a second union goes on strike once a first union goes on strike? Well, it probably increases the odds. Well, what about when a third union goes on strike? Well, that's another. So we're having all of these clusters happening, and you say, well, okay, well, how do you calm down a cluster? Okay, it's happening. What do we do? There isn't a lot to do. What we need is calm. And the only good news about this is called the Hawkes process. Okay, this contagion, the self-excitement. So what about the Hawkes process? There's one good element of the Hawkes process, which is that while it gets excited exponentially, that risk, that increased risk, that second type of stochasticity, it comes down exponentially too. So basically what the world needs is calm. We certainly are not getting calm. We are caught in several cluster shocks, I would call them. And this is when things that were once thought of as a tail risk, I'm just going to make something up that I don't think is going to happen, just to give an idea. JP Morgan going bankrupt. It's not going to happen. I'm just going to say, okay, that's a 20 sigma move, right? Like greater than double point precision. Like it's 32 decimal points with a zero. No, not 32, 32 zeros after the decimal point, right? So just take something that's not that seems very unlikely. Well, the distribution has changed because we keep getting shocks. The distribution keeps getting essentially discombobulated because we're shock after shock, this doubly stochastic process. And it's no longer a tail risk. Now it's actually within the realm of possible. Maybe something that had a 1 in 10 billion chance of happening now has a 1 in 10 chance of happening. And we have like 5 of those all at the same time. That was my best version.
Okay, so I'm not saying this to compliment you, but that's fucking brilliantly said. So I'm a big fan of Nassim Taleb type way of thinking and thinking
Yes.
about this. You're hitting on exactly the thing which most people really don't even comprehend because they live in a small sample and they think that just because one shock's happen, you're not due for another shock for a while. It's actually quite the opposite. And
Yes.
it's interesting that the word calm, it's like, what's the response to shocks from a financial monetary perspective? It's liquidity. Right. I mean, that's how you
right.
squash the clustering around the VIX, right? That you just throw money at the problem, liquidity comes in, and that's the fire extinguisher. You don't have that now. And the Fed doesn't want to risk also being whipsawed. So that's why, to me, this is so bizarre in the way I think most people are thinking about financial markets. It's like we are in an age of turbulence. We are in an environment where, you're right, things which would normally be seen as tail events happen more frequently, not because they're actual tail events, just because of the nature that the extremes are so tightly clustering that it makes the next extreme even more likely.
Yeah, that is the real concern. I think we're realizing some of them, but I'll say this. Let's say you put something out on your Twitter feed that you say, hey, the risk of XYZ happening is going up. Okay, great. And people say, so most people will agree with you, but then you have, your detractors. Same thing for me, right? And what I think people are not understanding is when someone says the risk of XYZ happening is going up, that doesn't mean it's a prediction that XYZ is going to happen. It can be, but what's saying is that what used to be a 1 in 1,000 chance is now a 1 in 10 chance. And if you don't understand that some event, I'm going to roughly use the word bad. If some bad event had a chance of has a 1 in 1,000 chance of happening, and it is now moved to 1 in 10, that totally discombobulates the way market prices risk. It's a total destruction of what we thought was possible, what was possible in the past, and what is possible in the future. It changes everything. In particular, we can bring it down to assets. It changes valuations and the way you create valuations, not just of stocks, right? Of bonds, of risks of recession. And that is why, this mathematician would say, that is why we see such violent moves in, let's say, the long end of the yield curve. Okay, why did the Fed really change their language that much? Not really. Haven't they kind of been saying higher for longer for a while? Why did it all of a sudden strike the market after the September FOMC meeting, then the presser and blah, 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 and then the statement of the summary of economic projections? Why did suddenly the same words change the long end of the curve? Because the distribution changed. It's a different distribution. When you say it 7 times, 8 times, 9 times, there's a magical number, the 10th time, whatever, when that event, that 1 in 1,000 event becomes a 1 in 10 event. And then people realize, oh shit, it's not a 1 in 1,000 event. It's a 1 in 10 event. We have to change how we're pricing it. And that's what we're seeing. I think how about this? That's one supposition.
So I have myself on mute, but I'm not, no bullshit. I'm literally saying, fuck yes, you're 100% right. And that's why this is so remarkable. Now, let's take that to credit spreads. Okay, so because this is where I keep going back to, look, I've been wrong. Right? I've been wrong in saying it. I keep going back to treasuries are not a hedge against stocks. They're a hedge against credit spreads widening, which is what makes them a hedge to stocks, which sounds a little Dr. Seuss-like. But the link is to credit spreads, right? That's what's the thing that's been missing. So let's apply that thinking, that process to credit spreads because they've been abnormally tight. I happen to think that they're now on the verge of blowing out. Just from a time frame perspective, I think you're very close now. But let's play it out from your perspective.
Yeah, so I agree. Let me just one thing you said, and of course it's a disaster for PMs. I mean, not to state the obvious, but maybe it's necessary for listeners. Just to everyone listening, the 10-year Treasury was supposed to be one of the safest investments in all of finance. Okay, and it has completely crumbled. So this would be a 1 in 10,000 thing. So no one who uses the 10-year Treasury as a sort of bastion of safety, some semblance of safety that got shellacked, really, they didn't do anything wrong. It's supposed to be. Okay. Now, to answer the question with credit spreads, I know you believe, and I believe too, that there's still, we've seen the long end of the Treasury market just react, right? The probability distribution has changed. What was once really remote has now become far less remote. Boom, things change. I believe that they too have changed in credit spreads. So let's say just slightly below investment grade debt. And the spreads, what Michael's talking about, is a spread between the rates on those versus, those backed by the full faith and credit of the United States government. Why aren't they wider? They should be wider. Will they be wider? Possibly or probably, depending on your point of view. Whatever the odd would say this, even if someone doesn't believe credit spreads are good and widen, whatever the odds were prior, they've gone up. If that's the case, which I believe it is, much like what happened in the long end of the Treasury curve, it must be the case that the credit spreads should increase. It must be the case that there will be a contagion, but the odds of a contagion have gone up. Therefore, they must be reflected in the prices of assets. Bond prices, the prices for higher yield securities, they have to come down. The risk of there being credit events that hit them and then there being a contagion, the risk has gone up. The parameterization of the distribution has changed. When will it happen? I don't know. Is it absolutely going to happen? I don't know. When it happens, will it be fast? That part, I feel very comfortable coming on the record and saying it's going to be fast. When it happens, it happens. It's very much like employment numbers. When we start getting unemployment, I'm not saying we are, but if we start getting unemployment, they don't kind of like slowly trickle down, which feels like what the Fed wants. It's just like it's an avalanche. And why is that? Well, you tell me. It sounds like a Hawks process, right? John loses his job. Jane loses her job. John and Jane stop shopping for more. Well, since Jane and John stop shopping for, their Nikes or whatever, well, then some people at Nike have to get fired. So Matthew and Linda get fired, right? It's all a contagion. So credit spreads should be widening. I think they will widen. I think being short credit is the right place to be. That doesn't mean I think there will be a disaster. There could be. But I do think the risk parameterization has changed, and that must be reflected in asset prices. It must be. That is what asset prices are. They're a reflection of stochasticity and the risk inherent in that stochasticity. That risk has gone up.
And I would add, you could argue that certain parts of the marketplace are sensing that. Yeah, it's like, why is it that small caps have done so poorly? Well, because they're highly levered. I mean, they're the junk debt of the market cap space just by the very nature of them being smaller and more zombie companies. So, listen, my thesis all along at the start of the year was melt up pre-election year, but that there's some kind of tail event, credit event towards the end of the year on the realization that all these loans are going to be refinanced next year. Most crises are refinancing crises. The bond market and stock market, seeing that you're going to have this wall next year, will start to respond off of it this year, right? And around this time. And so far, I think that's actually starting to play out. Now, nowhere near did I ever imagine that Treasury sovereign debt would act like this. Right? So this has been a whole nother dynamic in terms of how this plays out. But I just continue to find it hard to believe you can't have a severe credit crisis, or rather that a credit crisis is not inevitable when you've had a duration crisis. I know it's possible that we don't have a credit crisis, but there's cause and effect when it comes to the risk-free rate.
There is cause and effect that we actually saw in the regional banks, right, already. So recent history. I would say you've been pretty ahead of the curve. This is where you and I differed, and I think it's proving out that you were right. I had this idea, which I think was held by many people. So I think you were actually anti-consensus. So you were right and anti-consensus, and I was wrong going with the consensus, which is the worst way to be wrong. While people, I'm just going to bring up one market. It's certainly not the, you could talk about durable goods. I'm just going to bring up the commercial real estate market because it's kind of like topical, but there's others. I think I was talking to, trying my best to talk to funds that are managing their, commercial real estate. And a lot of what I got was this idea, and you were right about this, or it certainly seems like you were right about it and I was wrong about it, is that they had this, I don't mean to overstate it. This is heuristic. It's not like, it's not like a study, but my experience was that they were believing that, yes, they could not refinance at, let's say 6 months ago, they could not refinance at rates 6 months ago and still have a commercial enterprise that was going to survive, right? That was solvent. As you say, but shouldn't that freak you out? And they say, no, because when we refinance in 2024 and 2025, we think rates will be back down, right? Which sounds a little bit like head in the sand, but also sounds a little bit like that's possible. In fact, it was consensus. And this is where I think you were ahead and I was behind. What if rates don't go down in 24 and 25? What if they go up from where we were 6 months ago, which they are? Well, then the contagion, the refinancing kind of follow-on impacts that many commercial real estate owners, large owners would say, I don't know, $100 million. They're openly say that they're not solvent at these rates, right? Well, what if they have to refinance at those rates? Or how about this? What if there's a crisis in faith? Well, let's talk about probabilities, Michael. What if they thought the probability of them having to refinance at higher rates was 5%, just make them a number. And now they think it's 50%. Well, what are you going to do? Okay, everybody listening, you are a commercial real estate company. Say you have $100 million of commercial real estate. So the way these companies work is they have collateralized debt. You can think of it if you own a mortgage, like an interest only loan, kind of. That's kind of how it works. Okay, these CMBSs, you just keep paying the interest, blah, 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 blah. You're paying $1 million in interest, but you're getting $1.5 million in rents. Just making up numbers. Okay, and that leaves you some wiggle room. Rates can go up a little bit. Rents can come down a little bit, right? That's how you measure safety. But at today's rates, it's no longer $1 million in interest. It would be $2 million. So you're not solvent. And by the way, the $1.5 million in revenue you were generating for your rents, that's going to come down. Maybe there's going to be vacancies. Maybe there is disinflation in rents, right? So these are the problems that I now think will surface, how about this? The probabilities have changed that they will surface. And that's where you were right. You were, as far as I remember, you in 2023 were saying, hey, of course, there's a chunk that only has to get done in 2024 and 2025, but let us not fall so comfortable. Let us not fall prey to the idea that it's a guarantee that 2024 and 2025 will have lower rates than they do in 2023. And I don't even think that you said they would be. You just said, let's just not fall prey to that idea. Well, you're right. And that means if you're an asset owner, what are you going to do? Now, some of them are probably going to try and refinance now. They're going to maybe try and dissolve their, start selling. They'll take losses. These tend to be not necessarily all one company, like a bunch of LLCs. They're just going to start selling them, right? Like they're going to put their hands up and say, I don't want the property anymore. You take it, bank. And that's when we start to get real problems. And there's this saying that when I foreclose on my house, it's my problem. But when everybody in my neighborhood forecloses on their houses in my neighborhood, it's now the bank's problem. This is about to be a bank problem.
Fucking brilliant. The whole discussion of fear. No bullshit. Everybody, please make sure you follow Ophir Gottlieb. If anybody wants to come up and ask a question, click that bottom left mic request button. And again, this will be a podcast under Lead Lag Live. Okay, so I want to talk about behavior now for a little bit, because I think the behavioral part of this is interesting. I always go back to the best way to avoid a drawdown is after one's already taken place. Now, of course, you never know when the drawdown's over, except with severe, lag in time, right? But let's take this to what do you do about it from a portfolio perspective, right? I have no opinion on treasuries from a very long-term standpoint. For all we know, you're exactly right. Maybe those jokes that I was putting out last year saying I can't wait for the 30-year mortgage rate to be at 20%. You know what? Fuck it. We're in such a weird world. Maybe that's actually what's coming. And maybe treasury yields just keep on skyrocketing and all these narratives are right. But you are going to have these junctures where there's going to be some real tradable rallies. Right. What are you doing in your portfolio? Are you saying to yourself, you know what? I'm going to be in cash. I'm going to try to trade shorter time frames, look for the dislocations, the extremes. If it's not a tail event, if it's probable, maybe the best thing to do is, not play the game at all. Let's bring it down to implementation.
Sure. Yeah. So that's just a very good question. Okay. So I've said all these things and okay, thanks, dude. Now what? So in my stock investing portfolio, I was just going to say I slowed down. I've actually stopped DCAing. Okay. So that's not very sexy. That's just, I'm going to talk about something sexier. And the non-sexy part, that's what I've done. Okay. In the sexier part, which is I'm an options trader, an option trade for me is in general, I'd say on average 7 to 14 days. I do have longer term multi-year option trades, and I actually don't normally trade even much shorter than that. So let's say 7 to 30 days. Maybe it's better. So I am totally. It's a great thing about being a short-term trader in this regard is that I'm looking to take bursts of risk, right? So a position is risk. A burst of risk is like 10 of those positions. I'm just making it, whatever. So what do I see right now? I have seen, a slight pitch for our service. We have something called Trade Machine, which is for options analytics, options backtesting. And I said in our community, I'm like, I would get long vol now a little while ago. So I was like, this is like in late August. I'm like, okay, now might be a good time to get long vol. So what I'm doing, I'm looking for windows where I think they're going to be bursts of volatility. Okay. And now when I talk about bursts of volatility, I'm actually not talking about the VIX. I'm talking about realized volatility. So not volatility it's a good way to describe VIX. It's not forward looking, right? It's not a guess. It's realized, right? So there's implied volatility. That's a guess. And then there's historical volatility. That's realized. I'm looking for realized volatility. And I see that. I see a lot of opportunities, have seen a lot of opportunities, have been trading a lot of opportunities. I happen to be in tech a lot. I just speak to CEOs. So you don't have to trade everything all at the same time. So I've seen a lot of those opportunities. So I think there are still opportunities where the option market is pricing in a distribution. That's what an implied volatility is. Normally it's considered a log normal distribution, right? And I'm saying, that's fine. Let's stick with, the theory that got us 3 Nobel Prizes, right? Black-Scholes, roughly. But I think the distribution, the parameterization has changed, and therefore options on some companies are simply too cheap. Does that mean they definitely will move huge? No. It means that the probabilities have gone up and the price of the option does not reflect that probability. That's what trading is. Buy something for less than it should be. Sell something for more than it should be. Now, every time you buy something for less than it should be does not mean you will make money. And every time you sell something that's more than you think it should be does not mean you will make money. But if the portfolio, my options portfolio, is properly diversified, takes the speculations, kind of has 2 sides of the book, right? That in the long run should make money. That in the long run has made me money. And that is what I'm doing right now. Okay, so be specific. There are triggers in certain technology companies, not the mega caps, by the way, certain technology companies, not micro caps either. I'm talking in the $5 to $100 billion range market cap, where the amount of risk in a tail event or a tail-like event, doesn't have to be an actual tail event, those are no longer 2 sigma trades. Those are 1 sigma trades. Well, that's a violent mispricing, and I want to buy that. So that is what I'm doing. I'm looking for periods where there will be bursts of risk I'm willing to take. Then I stop. Then I look for bursts of risk I can take, and then I stop. And sometimes, even in this period where I've been owning volatility, I've been selling volatility, right? I say, okay, that's too much. Hold on. Let's come back. And I think this is a great time. I've said this for a while. It's a great time to be an option trader because the distribution, the probability distribution that is pricing options, right? That's how you get an implied volatility, right? From a probability distribution, generally considered a closed form, give or take. I think they're wrong. And so that's what I'm doing. So simplest, I'm buying vol that I think is too low. I'm selling vol that I think is too high. Of course, we're always doing that. I just see these opportunities presenting themselves much more frequently. And by opportunities, I mean the mispricing is far larger than it normally is. That means it's a fancy way of saying the amount of edge I think I'm getting is far larger than it normally is.
What's the source of that, you think? Is that just sort of complacency, or people still think we're in this new bull market? What's causing that mispricing from your perspective?
I think so historically, and I still think it's true, markets move, volatility markets, they tend to move. It's sort of, they move it. I don't know. Like the word I try to use is like regimes. They move in regimes. Like we're in a low vol regime, we're in a high vol regime. And that's similar to almost everything in the market. Like we're a bull market, you could say, is like a regime, right? A bear market is like a stock regime, right? So I don't think, I'll bring it back to where we started. I don't believe that market participants are fully understanding the consequences of a distribution, a probability distribution that has changed. So they still think we're in a low vol regime, essentially, is what I'm saying. And I don't think we are in a low vol regime. And so that's where I'm seeing it. I also think that to bring it maybe like a little higher up to the Fed, if you don't mind, let's go there. because the Fed has essentially turned into stock traders, right? So I don't think they're trading stock, but what I mean by stock traders is like they get a piece of economic data and they're like, oh, and now we're hawkish. And they get a piece of economic data and say, now we're dovish. That's not how central banks are supposed to work. So I think what I'm actually trading, and it's incidental, and this is where you asked me at the beginning, is being a mathematician good or bad? This is where I have to take off the mathematician hat and be a trader. I actually think the volatility regime discombobulation is because the Fed is discombobulated and it's not getting reflected in option prices yet. But I think it's a lot easier to make an argument that the Fed is, let's say, uncertain where they're going to go, really uncertain where they're going to go. It's much easier to say that than to say, oh, vols are too low. Or vols
and by the way, just to add to
right?
that, I don't know if you saw Powell yesterday, but I can't count the number of times he said, I don't know.
I'm okay with the Fed saying they don't know. What I'm not okay with, and again, I think you and I both know, like, there can be discussions that are internal and discussions that are for the public consumption. So I think we would both agree that we don't necessarily know everything the Fed thinks. Okay, but let's just live on what they said, because that's all. Then you and I are guessing on what secret conversations are happening. I don't really want to do that. It just doesn't seem to me that the Federal Reserve really has a plan. Like, I know the plan is to get inflation down, to do so by tighter monetary policy. First and foremost, well, they only have two tools, really. Okay, first and foremost with rates, and secondly with balance sheet moves, so you're shrinking the balance sheet. Okay, that's not good enough. So that's good enough for you and I, Michael, when we're managing our portfolios, to say, I get this piece of data, not economic data, doesn't matter. Whatever you and I are looking at, whatever signal, you say, okay, I'm going to get longer. Like if you're an option trader, what I just said, that's perfectly fine. Every 2 weeks, what volatility regime are we in? What volatility regime? Keep reassessing, keep reassessing. But the one thing about you and I that we don't do is we don't control the Federal Reserve of the largest economy in the world. You can't be a 2-week option trader if you run the Federal Reserve of the largest economy in the world. You must have a plan, right? And okay, Ophir, that sounds really smart. What's a plan? Sure, here's a plan. We have a calendar of economic data from now until the next 10 years. Okay. Take the next year. Pick the points that will drive your monetary policy. Fed, it don't even have to share with us. They've shared some non-farm payrolls, wage inflation, core PCE, retail sales, a sentiment, whatever the fuck they want. Okay, they get to choose. They're the Federal Reserve. Write it down. Write it down. If A, B, C, D, E, F, and G happen, we're going to do this. If A and C happen, but B, D, and E don't happen, and F and G are, gosh, I don't know, then this will happen. Write it down. This is what I tell people when they trade options. You are not trading if you don't have a plan. What you're doing is giving money to me because I have a plan and I'm going to take your money. And so will every other professional trader. The Federal Reserve needs a trader to talk to them. Write it the fuck down. What are you doing? You cannot react violently to a piece of economic data, not when you run the largest economy in the world. And this is a great failure. It is the first time I've ever seen it or I've ever read about it. I'm not that old. I'm 47, so I haven't seen, write it down. They must have a plan, and it's not that hard. It doesn't mean it's not hard to bring down inflation. That's not what I said. I didn't say trading was easy. I said you should have a plan. If the Fed has a plan and is able to communicate that plan in some regard. Maybe they don't want to give their full trading plan, right? They want to say these 7 things and these numbers. Okay. Just communicate, right? Here, I'm Fed Powell. This is how it sounds. Hello, world. We know you're all worried about what we're going to do with monetary policy. We are too. It's very volatile right now. We're not 100% what we're going to do. But we have a plan based on 13 metrics and the various outcomes of them, which would be, 13 factorial. So a large number. We're talking a large, if it's a spreadsheet, it's 100 million rows. And when certain things happen, we have a plan. Now someone will say, said Powell, are you absolutely going to follow that plan? No, we're still intellects. We still move with new data, but something would have to change our mind from the move that has been predetermined with this data. We have a move. We're going to raise rates if X, Y, and Z happens. X, Y, and Z happens, we're probably going to raise rates. Is it absolutely sure you're going to raise rates? No, we're still going to be a bit flexible, but something would have to dissuade us from a predetermined plan. That's how Federal Reserves are supposed to work. That's how the largest economies in the world work. That's how intellectuals work. And that's how traders work.
The issue is they are actively winging it. And it's not just them. I mean, speak about not having a plan. The Bank of Japan doesn't have a plan either. I mean, that to me still remains the real kind of what I call the mantra, right? It's the butterfly effect that's out there.
Yeah.
I mean, they keep trying to intervene on the bond market side because you can see yields are spiking. And the yen looks like it's on the verge of collapsing against the dollar. So it's like, now you're at a juncture where it's not just the Fed, it's also central bank of the third largest economy in the world.
Yes. I mean, Japan, so this is a part of a cluster, right? So we were talking, so here's the cluster we're talking about, monetary policy clusters, right? Shocks to monetary policy. Or probability distributions changing, the probability of a really big event happening, like Japan changing its monetary stance, right? But really, if you think about it, if the Federal Reserve had a plan and communicated it in some manner to Japan, wouldn't Japan then have a plan?
Yeah, no, exactly right.
So, there is a way to cushion the blow, to attempt to cushion the blow of these contagions. And one of them is to be mindful that instead of looking at the possibility of 7 things happening, you're looking at the possibility of 700,000 things happening. Okay, you still need a plan. Yes, the plan got harder. For fuck's sake, you're running the U.S. economy. Yeah, it's hard. Good. I'm glad it's hard. Do the job. Is it your fault if things don't work? No. It's your fault if you don't have a plan. Is it your fault as a trader? You put on a trade, you have a plan. This is what boom, volatility, stock price, blah, 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 blah. This is what I'm going to do every day. The single things up. Is it your fault if you're wrong? I mean, no, you're wrong. Is it your fault if you don't have a plan or don't follow the plan? Yeah, you're goddamn right it is. You're goddamn right it's your fault. Sure. So a great question. I'll give my answer. Michael, give your answer. My answer came back from sort of my preface, which is that we don't know exactly what the Fed is thinking. All we have is what the Fed has said. And I think both Michael and I would agree, I don't want to speak for him, that it's quite possible there's more information the Fed has than we know, right? But I said at the end of so to answer your question directly, the Fed isn't communicating that they have a plan. Therefore, my conclusion is that the Fed doesn't have a plan. Is that conclusion correct? I don't know. I think it could be correct. Am I so obtuse to think that there isn't information I don't know? No. Well, who talks like that? But one thing I said, it's actually at the end of that thread that started this whole conversation that Michael shared in the Nest. The very last part of that thread, it's a 19-tweet thread. I said, roughly speaking, maybe I'll read it word for word so I don't embarrass myself. It's very short. I mean, it was like one sentence. Yeah, I said this. If the Fed continues to message hopelessness, the credit markets will oblige. To me, the Fed is not messaging a plan. That is equivalent to hopelessness, and therefore a credit market event is more likely. So why do I think the Fed doesn't have a plan? Because they haven't said.
I would add, I don't think it's irrational to think that they don't have a plan because there's nothing in their models that can possibly give them a plan. I mean, what's happened the last 3 years, there's no precedent for, including in terms of their own actions. Right? I mean, they have no plan in terms of what happens going forward because they don't even know, there's nothing in the history books for the speed at which they moved rates. I mean, it's nobody can predict the future. The Fed is part of that. But the reality is, you can't even properly model out the last 3 years. We've never seen something like this before.
I agree. And I think it would have been impossible to have a plan for the more than tail events we've had. I think it's possible to have a plan now. I just want to be clear that I don't think they necessarily have a model. That's harder. But I'll just try to, this is just my opinion. This is not chapter and verse, right? It's just my opinion. Let's say I'm just going to make it really simple. It's not that simple, but I'm just going to make it really simple. So my example, I'll make a contrived example just so people grasp what I'm saying, and then you can judge with what I'm saying if you agree. That's fine. That's fine. But it's my job to communicate my idea. My idea is this. Let's just pretend it's not this simple. This is contrived. The Fed only looks at 3 things: non-farm payrolls, core PCE, and retail sales. Let's just pretend. Obviously, it's more than that. Okay. So the Fed can write down on a piece of paper, like an option trader can write down on a piece of paper, if month over month, core PCE for what would be reported for September, right? It's coming up soon, is this, and retail sales are this, and non-farm payrolls are this, we will do A. Okay. Now, there's 3 things there. So there's 6 possibilities of, okay, you write down all 6 possibilities, what you will do. You can plan that. It's not a model. It's not a prediction. You can say, we know it's a matter of fact, as long as the government doesn't shut down, we're going to get this data. We know that this is the data that we focus on. This is what we will do if the data we focus on comes in A, B, or C. That's all I'm saying. That's it.
Yeah, no, I think that's a very Well taken. But I don't describe it. You don't need to have a model for a plan. But the reality is, I think most policymakers like to have a model to rely on to say, well, we modeled it out, didn't turn out the way that we thought. I mean, there's a little bit of CYA when it comes to modeling.
It is. I mean, obviously, you're right. Obviously, the Fed, they do have a model. At the very least, it's the SEP. So, of course, the Fed needs to have a model. I guess it's breaking news. Cheesebro pled guilty in Georgia. Sorry, just saw that come across today's video. So yes, I mean, obviously, Michael, you're right. If the Fed literally doesn't have a model, then we're really fucked. But I'm just taking a step back and saying that they could communicate to us in a manner that doesn't necessarily even communicate that model and just says, look, these are the things we're looking at. Just so you guys know, here's kind of the things, here's the things we want to do. I'll put a question out to the crowd. Just fair enough. How about this? I'm going to give you something that is not contrived, and I want to see if anyone really thinks they have an answer. The summary of economic projections had core PCE year over year at 3.7% to finish the year. Okay. That's just a statement of fact. And of course, the SEP is it's the median of 19 people, blah, blah, blah. Okay. Let's pretend that's a model. Hopefully they have a better model than that, but let's say this one. What if core PCE year over year doesn't come in at 3.7%, but comes in at 3.4? That's not really a tail event. It's less likely than likely. It's possible. It's not contrived. But non-farm payrolls dip to double digits and retail sales go negative. That is a very plausible outcome. It's not a prediction. It's not that contrived. Does anyone here think they know what the Fed would do? Because if the Fed was communicating correctly, we should know exactly what the Fed would do. That is not so tail eventy that we should be like, okay, all right, the next 3 months, core PCE comes in softer than we thought. Payrolls are softer than we thought. Retail sales are down. Okay, the Fed will do this. No, does that mean they have to cut? I didn't say that. I'm not imposing a policy decision on them. We as listeners, as civilians, as citizens, should know at the very least when something that is semi-likely to happen, possible, we should have some fucking idea what the Fed is going to do. And I'll tell you right now, we don't.
My neck is hurting from how much I'm nodding, listening. Sincerely, I mean, everybody, please make sure you follow Ophir here on X. Ophir, for those who want to track more your thoughts, and you mentioned the business you're working on, just give a little bit of context as far as where people can find more of your stuff.
Sure. If you want to hear me give diatribes and write about economics and stocks, you want to go look to CML Pro. Okay, just Google CML Pro. We should, that's us. It's a monthly subscription to my research. I don't know. It's both tech stocks where I talk to CEOs, but share transcriptions, and then economic discussions like this. If you're an options trader and you're like, that was cool, I don't think right. Then we have something called Trade Machine, which is an option backtesting tool, which allows you to essentially identify patterns in the past and see if they fit the present, which they very well may not. So that's easy, trademachine.com. So CML Pro on the one side, Trade Machine on the other, or take both.
This was, I posted during the hour, this is like a masterclass. There's so much that you said, which not only I agree with, kind of goes to my own kind of philosophy in terms of way to think about the unknowable tomorrow, but the way you communicated, I think, Ophir, was phenomenal. Everybody, please make sure you follow him, check out his various work. Just recognize it's always about probabilities, and a lot of things are being mispriced in people's minds. So thank you, Ophir. I really appreciate it.
Thank you so much, Michael.